Two guys, same age, same city, same $50,000 in the bank, and the same $55,000 salary. They start at the exact same financial point in life, but they make one different decision. One uses his $50,000 as a down payment on a rental property, while the other invests the entire amount into a low-cost total stock market index fund. 20 years later, both become wealthy, but the journey, risks, stress levels, and effort required to get there are completely different. The real estate investor uses his $50,000 as a 20% down payment on a $250,000 rental property. He secures a 30-year mortgage at 7% interest, giving him control over a much larger asset than his initial investment. The monthly mortgage payment is around $1,330, and he rents the property for $1,800 per month. At first glance, it looks like he is making about $470 per month in positive cash flow. He feels confident because he owns a physical asset, collects rent every month, and watches his tenants help pay down his mortgage. The investment feels tangible, impressive, and rewarding. The index fund investor takes a completely different path. He invests the same $50,000 into a total stock market index fund and sets up automatic monthly contributions of $300. He owns tiny pieces of thousands of companies across the economy. There are no tenants, no property inspections, no mortgage applications, and no repairs. His investment simply sits in a brokerage account, quietly compounding over time. Unlike real estate, there is nothing exciting to show friends or family. It is boring, simple, and easy to ignore. During the first few years, the rental property appears to be the clear winner. Rent checks arrive every month, property values increase, and mortgage payments slowly build equity. The landlord enjoys tax deductions such as mortgage interest and depreciation. Everything seems to be working exactly as planned. At the same time, the index fund investor sees his account slowly grow from $50,000 to $55,000, then $61,000, and beyond. The growth feels slow because there are no monthly rent payments and no visible signs of progress. However, as the years pass, reality begins to appear. The rental property generates rent, but expenses quickly eat into the profits. Property taxes must be paid every year. Insurance premiums increase. Appliances break. A water heater fails. A roof leak appears unexpectedly. Tenants move out, causing vacancies and lost rental income. Advertising costs, cleaning expenses, and repairs become unavoidable. What initially looked like strong cash flow shrinks dramatically once all real-world expenses are included. Over 3 years, the property owner collects tens of thousands of dollars in rent, but after accounting for property taxes, insurance, maintenance, repairs, vacancies, and turnover costs, the actual profit may only be a few $1,000s. The real estate investor spends years managing tenants, repairs, taxes, and unexpected expenses while benefiting from leverage, property appreciation, and rental income. The index fund investor simply invests consistently each month, allowing compound growth to build wealth over time with minimal effort. By 10 to 20 years, both investors can achieve similar net worth, but through very different paths. Real estate offers higher involvement and potentially greater rewards, while index funds provide simplicity, diversification, and liquidity. Ultimately, neither is universally better. Both can create substantial wealth, and many investors benefit most by combining real estate and index funds for long-term financial success.